Okay, friends, so welcome back. So now we are going to make a final attack on your subject balance sheet management. Okay, friends. So only few days at our disposal. Yes, we'll cover important aspects one by one. Okay. Now I will load my screen. I think we left at one point. I will continue from where I left. Okay, friends, are you all seeing the screen? Yes or no?
Yes, sir.
Yes, sir.
Okay, very good. So to understand the liquidity risk in, especially in 30 days, I am giving one more example. Okay, this is already they have grouped it. For example, you see, yes, because this is one of the important gaps for every bank, that is maturity, mismatch, negative. Okay, yes, I will load my laser also. For example, maturing assets maybe in crores. It should be in crores for a bank. Overnight, that is next day, 40 crores. Loan repayment, 10 crores. So these two are inflows. Maturing deposits, 120 crore deposits are getting matured. And loan dispersal, you are committed, sanction is there. So this is outflow. These two are inflow, outflow. They are given, but in the scenario, sometimes they may not given. They will give in a format. They will all give jumbled. You have to rearrange it. So here, these are the inflows. These two are inflows. These two are outflows. Here inflows, outflows. Here we have given deliberately. Here all the gaps, all the buckets is a negative gap. For example, okay, what is the gap in overnight bucket? So simple. 40 plus 10, 50. Here
200.
120 plus 250. So 200 is the gap versus 250 outflow. Always the gap will be the percentage of outflow. Keep in mind. Okay. So 200, 250 mean, oh my God, 80% is the gap. Oh, it is beyond RV limit, you know. So bank has to do something. Okay. Next, for example, next. What is the gap in 2 to 7 days? So here 60, here 400. So 60, 400 mean 340 crores is the negative gap, and the negative gap in percentage is always you have to link it to outflow. So 340, 400 mean here also 85. Oh my God, 85. Okay. Then the third one, sometimes it will happen. Suddenly, during a particular month, withdrawals will be more, okay, in a particular maturity bucket, and to that extent, inflows will not be there. So in that scenario, it becomes a negative risk, negative gap for the banker. You have to manage by doing arranging funds or doing some swap transaction, and you have to bring it within the. You have to bring it within the. You have to increase the inflow by doing something. Okay, so they will ask how to manage the negative gap such a wide. You just tell yes is a shifting of maturity or doing a swap transaction. Okay, so like that they will increase the cash flows in that particular deficit bucket so that they will make the deficit very manageable level. So the third, that is 18 to 48 also. So 500 is the outflow and 170 is the only inflow. So 330 crores is the negative gap. So 500 is the yes expected outflow. So percentage wise 66. So easy, just like that gap they will ask. How to calculate the gap? This is how you have to calculate. First you have to arrange. If there is any misarrangement, then it will all answers may become wrong. So correctly identify the and correctly you have to put in the bucket. So yes, they are asking definitely maturity. Minimum 5 mark questions will be there. So the gap in the fourth bucket is 270 is the inflow, and the outflows expected are 800. So 800 minus 270, 530 divided by 800. So 66.25. So the message is in all the gap, it is in excess of the RBI prescribed limit, prudential limit is all exceeded. Now, what is the cumulative gap? Cumulative gap means you have to add all that. All are negative, 200 plus 340. Okay. Wow, correct. 200 is the negative gap. 200 plus 340, 540. So like that, if you add, it will become 1400. The cumulative gap in this one, yes, 1400. Here I have added positive. Okay. So the total gap, cumulative gap is 1400. And what is the 1000 expected outflow? Outflow also, all outflows here, if you total it, 3250, 400, 500, 800, 1300, 1700, 1950. So the overall cumulative gap is 7179. So this is RBI has how many buckets in excess of RBI limit in all the 4 buckets? So the answer is simple. Now this is the question, important question. The last question is now new concept, the LCR, the HQLA, high quality liquid assets. The high quality liquid assets is going to come in the next few slides. Just wait. Okay. High quality liquid assets a bank has to maintain. There are 3 levels. Okay. Level 1, level 2A, level 2B. You have to group that liquid assets, high quality liquid assets. Absolutely without any difficulty, we should be able to convert those assets into cash to meet our emergent outflows. The gap, it will damage the negative gap, it is not tackled. So that is why Basel III advocates, you should have a HQLA at least to meet the expected outflow. The expected outflow is 1400. So your high quality liquid assets should be at least equal to the negative gap, cumulative negative gap in the first 30 days. Okay. So you may wonder, sir, why 28 another 2 days? Don't worry. So this is the cumulative gap, small, no? So the total gap 1400 should be backed by high quality liquid assets, that is 100%. So the LCR is equal to the definition of LCR, all of you know, the high quality liquid assets should be equal to or more than. High quality liquid assets should be all category of high quality liquid assets after haircut. Some low quality HQLA, they will undergo a haircut. All should be put together, should be equal to or more than the negative gap. Negative gap. Here the negative gap, aggregate negative gap is 1400. So they should have 1400 crores liquid assets, high quality liquid asset to tackle the issue in case of any crisis. Agreed? So this is the question they will ask. So now we will go to question number 61. Next, don't worry about the running number and all. Yes, now, yes, next question. Bank ABC issues 12 crores PNCBS at issue price 15 and premium 10. These are the some live situation. Some because they will not give anything directly. They will always try to give some data, and how you are going to interpret that is easy. Just to understand, Yes, 12 crore PNCBS, that is perpetual non-cumulative preference share. They are issuing some preference share, perpetual non-cumulative preference share. It is not cumulative, so it will qualify as tier 1 also. At the issue price 15 and the premium is 10. So total price is 25, issue price 15, premium. Okay, so the 12 crore. So the 12 crore shares, 12 crores of preference share. So 12 into 30. So 15 into 25, each share is 25. So 12 crore into 25. Don't put cyber. So 12 crore into 25 will become 300 crores. Understood? So sir, 12 crore how to, the crore you keep it silent. 12 crore, don't, some people I have seen, they will put 0000 and they will put 25. No, don't do like that. It will be a time waster. So 12 crore let it be silent. 12 into 25, 12 into 25, 300. 12 into 25, 300, no? Correct. So the total crore, 300 crores of PNCBS issued. The total RWA, total RWA means TRWA. Credit risk, every risk is 15,000 crore. Now the question is, how much of this PNCBS will be recognized as 81 capital? You know, but now you have to apply in practice. Okay. So the answer is this is. So the value of the PNCBS is 12 crore shares at 25 per share price. So it will bring them 300 crores cash flows. Okay. Out of the 300 crores, the 81, minimum 81 will be 1.5% of TRWA. TRWA means total risk-weighted assets. Okay. Okay. Total risk-weighted assets, both will qualify under the premium as well as this one will qualify under 81 only, not CET. CET. So the how much maximum you can allow? 1.5% of total risk-weighted assets. What are the total risk-weighted assets? 15,000. So 15%, 15,000, 1.5% mean 225 crores will be put as additional tier 1. Understood? So then you may wonder what will happen to the remaining 75 crore. That will be pushed to tier 2. That will be pushed to tier 2. So 300 they have mobilized. Entire 300 will not be recognized as 81, that is additional tier 1. The remaining 75 will be recognized as tier 2. How many of you understood? Same question, if it comes, don't miss it. Understood or not? The rule you understand.
1.5 where it will be mentioned.
This is by default. This
1.5.
is by
Yes, sir,
policy
understood.
standard guideline. So this you have to
Okay.
remember. That is why I
Now,
told
this is for
something.
additional tier 1, na? 1.5 for additional tier
Yes,
1.
yes. This will qualify only as additional tier 1, not qualify as common equity. CET1, they will not qualify because these are all perpetual. These are the new instruments. New instrument mean other than perpetual non-preferent, non-cumulative preferential. That is why it is
So,
called as PNCPS. Okay.
if it's equity, it's 5.5 only.
Yes. Okay, understood. So this you have to understand. So if you know this background, then only can attempt this question. A simple way you
For tier
keep
2,
it
sir.
in mind. Huh?
For tier 2
Tier,
in
tier 2, there is a ceiling is there, no? You push it right now, but tier 2 also there is a ceiling. What's the tier 2? Total tier
Up
2
to 2%.
should not
2%.
exceed, that is maximum. Yes. 2% of the total
that's
risk-weighted
all. Okay.
assets. So
Okay,
total
sir.
risk-weighted means the 2% means 300. Up to 300 you can know. There are other things will also come. Other things like provisions, counter-cyclical provision, subordinated debts, all will come under. Just wait. I am giving a summary at the end. Okay. So this is question number, this question. Okay. Number you don't worry. Sometimes the number will be zigzag. Now next question. A bank issues innovative perpetual debt instrument. This is the IPDA they will use. That means you have to expand, understand. So it's an innovative. What is innovative? It will be always issued with call option. Never put option will not be given. Again, it can be exercised only after 5 years. If the banks are having more funds and the interest rates are falling down, what they will do? They will redeem that bond because now they can get the funds at a still a cheaper rate. Why pay unnecessary high interest? Okay, normally the perpetual bonds will be this innovative debt instrument always will attract high rate of interest because slightly high rate of interest because the investor is going to block for indefinite period. The perpetual mean the due date will not be predetermined. Okay, you understand? Perpetual bond. I think all of you are aware of the concept. It will be issued without indicating the due date. Can you visualize that deposit received? Received rupees 10,000. After, oh no, you have to tell received rupees 10,000 for a period of 3 years and the rate of interest is this, like that. You have to issue the receipt. But the perpetual bonds will not have a maturity, a prefixed maturity period will not be there. That is why it is called a new innovative instruments. Okay. So here how
So
much?
it's
Yes.
always on call option or put option? Call option.
Yes, yes. No, put option not permitted. Call option means bank only will have the rights. The rights are with the bank. That is, the call option means issuing company or issuing bank can only exercise the rights for premature redemption. And the investor cannot claim premature closure, premature winding up. Okay? Yes. Agreed, friends? So the
Only
IPDA, innovative debt, will qualify as 81 only. The additional tier 1, but this you have to always keep in mind. The additional tier 1 maximum. So for CET minimum, it can be anything. But 81 cannot be more. Tier 2 also cannot. Only two things are restricted. Tier 2 also they are restricting. And additional tier 1 also they are restricting. Otherwise, other capital, yes, it can be more also. The minimum level, it can be more also. So that banks will be strong. Okay. Why they are not favoring this additional tier 1? Because these are all perpetual. Anytime it is operate. It's not a, is actually, yes, it's a long time borrowing. So the Basel III guideline do not encourage much of, yes, perpetual bonds to strengthen the capital structure. Agreed? So the same rule will apply. Okay. Now next question. Capital reserves, how created? Sometimes the revaluation reserves, how created, you remember. By revaluing the fixed assets. The capital reserves, how it will be created? By sale of fixed assets. For example, capital reserve, how shown in the balance sheet? Yes, for one example. Okay. Not only theory, you know how the capital reserves are created. For example, capital reserves created when capital assets like building, okay, any other copyright or any other yes, is getting sold in the market or to somebody for a value more than the book value. Book value may be 50 crores, but you are selling for 150 crores. The 100 crores will become a capital reserve. So the entry will be, it will not be credited to profit and loss account. It will be credited to capital reserve account. It will be qualifying directly as tier 1. It will be qualified as tier 1. That is CET tier 1. CET. Tier 1 also, there are two layers are there. It will qualify as CET, Common Equity Tier 1. Okay. Only these two things will qualify as the additional Tier 1. Okay. The reserves will be shown as CET1. It's a part of CET1 without any discount. Okay. Next question is, okay, we have to cover no revaluation reserves. Always there is a problem. Revaluation reserves, how it arises, how it will qualify. Revaluation reserves mean what? Suppose you are not selling a building, you are only revaluing a building. Suppose your corporate office, as per the book, as per the book entries, as per the book value is okay, maybe 500 crores. But the current market trend is 2,000 crores. It's a very big building. So the 1,500 crore is the revaluation reserve. So the difference between the book value and the new value, they will load it in the book. Okay, debit premises, credit where they will credit to revaluation reserve. How the revaluation reserve? It will always qualify as earlier it was categorized as tier 2. Then RBI told yes, it will qualify as CET1. Okay, but subject to a discount. Discount means don't take the entire face value. For the purpose of calculating CET1, only 45% will be recognized. 45% will be recognized. That means discount of 55%. You understand? Minus 55%. So then that will qualify as a CET. Then don't ask where the 45 will go. It will be there only. But only for the purpose of calculating CET1, only 45% discount to 55. Then the 45 only taken into account for the purpose of. Otherwise, it will be there only.
So it will be in tier 1, sir. Tier 1.
Yes, yes. It will be
Only
in the
45
tier 1.
taken.
Yes, yes. It will be recognized as tier 1, but the purpose of calculating tier 1, that is CET1, only 45% of the revaluation reserves will be taken as the real value. The discount 55%. It will be discount. Discount means you are reducing the value. Discount 55 means you are reducing the value. Okay, that is how it will be loaded as a CET1. CET1 means, yes, common equity tier 1. Now, another one reserve is there. They are creating reserve for foreign currency translation reserve. That is sometimes, you have made a borrowing, something is receivable from the other country. In the process of receiving export receivable or some other receivables, something is due from the foreign country. So in the process of receiving the foreign currency, finally accounting in India, there may be a problem. You may realize the value $10,000, $10,000, $1 million we realize, but the $1 million when accounting in rupee, on the date there may be some fluctuations in exchange rate. The exchange rate may be, yes, rupee may weaken or rupee may strengthen. In the process, the bank will have suffer a loss. So that reserves, they will create a reserve to absorb a loss. So that is called FCTR. FCTR means foreign currency translation reserve. This will also qualify as CET1, but subject to a discount 25. 25 discount means 70% of this will qualify as CET1. Okay, CET1, there is no limit. There is no ceiling and all. It can be as much as possible. A bank can have the capital. Okay, only for 81 there is a restriction maximum. Similar way, tier 2 also restriction. Otherwise, other
Thanks.
capital, it can be more also. Okay, so that extent, yes, understood. These
Sir,
two things you remember.
The translation.
again, STR.
There is a translation, no? So the foreign currency has to be converted to Indian rupee, or the foreign currency due from other country, you have to realize and bring to India, repatriate to India.
Okay,
In the
sir.
process, we may suffer a loss. To absorb the loss, we have created a reserve. That reserves can qualify. Reserves is nothing but out of your profit is a cushion for a future loss. Capital is also a cushion for the future loss. So all reserves and capital ultimately meant for absorbing a unforeseen loss for the bank. Why the bank keeps so much capital? Just to absorb the loss. In case of doing business, ultimately they end up with the loss. Okay, to absorb the loss, capital. First hit will be on capital, not on creditors. Afterwards, only creditors will be affected. So there are the liabilities comes under three categories: short-term creditor, long-term creditor, net worth, capital. So any loss will first hit the capital. Okay, then only secured creditor, unsecured creditor, operational creditor, financial creditor. That is a priority. That is legal. Don't worry. So here, for the purpose of our balance sheet management, this will be taken as CET1, but at a discount of 25. Agreed. So this you remember. They may give some questions also. You have to, yes, I will give a question right now. Okay. Now general provisions on standard assets and provisions on other assets, NPA. So the entire provisions, okay, general provision on standard assets, provisions on substandards, provision on doubtful assets, provision on loss assets, all these provisions will qualify as what? Tier 2 only, but there is a ceiling. Entire thing will not be, there is a maximum. What's the maximum? The provisions alone, all provision put together, they will qualify as tier 2, subject to a maximum of 1.25% of CRWA, not total risk-weighted assets, only credit risk-weighted assets for the bank as a whole. That is 1.25. Here you remember 1.25. There you remember 1.5. That is an 81. These things you have to remember. By heart you have to do. Here it is 1.25 of CRWA will qualify as tier 2. Agreed? So this you can remember. Then where the other will, it will remain. But for the purpose of calculating tier 2, this will be taken into account. Okay, so they are considering, yes, only for provisions and all, 1.25% of credit risk. When we are creating provision only to absorb the credit risk, So that is why this is linked to CRWA. But that 2% linked to total risk-weighted assets. Okay. So these differences you keep in mind. Sometimes they will ask a live question also. For example, now another question I am giving. A bank has got 80 crores at foreign currency translation reserve, that is FCTR, and 600 crores as revaluation reserve by revaluing the fixed asset. Now the question is, how much will qualify CET1? Not yes, that is tier 1. The main component is common equity tier 1. Okay. So the FCTR, as you have just now understood, now you are applying the, yes, what you understood, you are applying in the numeric. So FCTR minus 25%, 80 crores minus 25%, 60 crore will be recognized as CET1. Okay, because at a discount. For the purpose of it will be there only. But for the purpose of calculating CET, only 60 crores will be recognized because discount. Similar way, revaluation reserves are 600, it will be there in the balance sheet. But for the purpose of calculating, recognizing as CET1, it will be 45%, 600 minus 55, overall it is 45%. 270 crores only will be recognized. So the 60 plus 270, 60 in FCTR, the 270 in revaluation reserve, totally 330 crores only will qualify as CET1 for the purpose of computing CET. Understood? These things you remember. Sometimes there may be numerical. Okay. This I will, on finishing, I will upload. Then you go on revising. Okay. Any doubt at any point of time with regard to what you have discussed. And you have already got so many materials from IBS and during our regular session. That also you have to read. But now I advise, okay, it's my gentle advice. Okay. Don't read big books. There is no time. You concentrate on the bullet points. I think IBS has shared a lot of bullet points, lot of presentation during your regular courses. This is only a revision. The revision ultimately you cannot do 100%. We cannot do. So main aspects we are just recollecting. Understood? So this question over. Understood or not? Okay. Now, which of these cannot be considered tier 1? Sometimes they will in a twisted way. What can be recognized at tier 1? I will give a chart. Don't worry. The complete chart. I think IBS also has given. Same chart I will give. It's a very ready reckoner. Okay. IBS mean? Yeah, yes. Yes, our IBS. Okay. So, which cannot be considered tier 1 capital? Innovative perpetual debt. Okay. Perpetual cumulative. Cumulative will never be. Yes, it should be non-cumulative. Okay. Cumulative means what? It will be added. So the perpetual cumulative preference share will never be, okay, why? I think at this point of time, okay, this will, so the share premium always tier 1, perpetual yes, C and D, A, C, D qualify, only B will not qualify as what? Tier 1, that will qualify as tier 2 only. So A all will qualify, C will qualify, D will qualify as tier 1, B will qualify tier 2. Okay, simple. Yes, sometimes they will twist you. Yes, quick answer. What are the deduction from tier 1? The tier 1, something you have to knock off. What is knocking off? Intangible assets, remember, always will be knocked off. What is intangible assets? You are keeping it in the balance sheet. That is okay. But the real capital, tangible net worth is you have to knock off something. What is knocking off? Knocking off means that you are removing those from your tier 1, CET tier 1. What are the thing? Intangible assets you have to remove. Okay, I think okay, something. Why it is moving like that? Okay. Intangible assets always it is a namesake you are creating, but no realizable value. Okay, goodwill, this R&D. At the time of liquidation, it will not fetch you any value. So right now you recognize, you just knock it off. Basel III notes, accumulated loss, knock it off. That is reduced from the capital. Deferred tax assets, the DTA. DTA also you knock it off from the tier 1 capital because just a adjustment entry. The DTA mean the excess of taxes that is in the asset side. So you have overpaid taxes, you are, oh my God, okay. Okay, DTA, that will also be knocked off from the tier 1. Investment in financial subsidiaries also now Basel III recognizes. Don't recognize the investment because this will ultimately may become a loss. So you first, right now, intangible will become a loss. That is right now we reduce. Accumulated loss, already loss, you reduce. Deferred tax liability also for the purpose of calculating tier 1, you just don't recognize, you minus it. And investment financial subsidiary, how they have to, they advocate, subsidiaries, 50% will be deducted from tier 1 and another 50% will be deducted from tier 2. So the investment subsidiary, totally it will not be deducted from tier 1, 50% of the investment in subsidiary. So they are advocating it's a thumb rule. Thumb rule we have to respect. So auditors will take into account. Okay. So for CAIIB, these are the questions they will ask. What are the deductions from tier 1? They will give 1A, B, C, D. So these things have to be, because this will ultimately become a loss. So better right now you recognize your tier 1 without all this add-on. Yes, add-on assets. Add-on assets mean invaluable, no negligible value or invaluable. Right now you, yes, that is the realistic way, real-time way of calculating your tier 1, CET tier 1. Not in, yes, tier 1 consists of 2. So you knock it off. Knock it off means reduce it. This is one question. This instrument, I think
So in
this
the
already.
previous question, I have a doubt.
Yes, tell
So
madam.
the question is, what are the deduction from tier 1? So intangible accumulated, why we will add this? These all will be not added in tier 1.
It doesn't.
So,
No. What happened, madam? This tier 1 will appear in the other side, madam. The tier 1 will appear in the liability side. But these things will be on the asset side. These are all assets. But why they are wanting us to, on the Basel III, this is only for the purpose of calculating tier 1. Only for the purpose of calculating what the real tier 1, these are to be deducted only. Now, otherwise, intangible will appear in the balance sheet only for the purpose of real tier 1, your real strength. Sometimes, your real strength you should know, madam. That is why this is only artificial strength. So this will be appear in the asset side. So right now, you minus it. Your real strength will be, anyhow, it is going to cause a loss. Right now, you don't recognize this as a part of your, not as a part, it will be an asset side. So that ultimately intangible assets will become a loss mean it is going to be some only book entry. Sometimes, it will have no market value, but simply they will accommodate as a intangible assets instead of absorbing to P&L account. And accumulated loss also what? Instead of accounting the P&L account, they have parked that entries in the asset side. But your asset side, ultimately everything becomes a loss mean, non-receivable mean. The DT also, DTA mean tax receivables. The overtax you will have paid or reassessment you have done. So when you will receive, so till you receive, don't recognize as a, is a valuable asset. So better knock it off. Similar way, they don't encourage in investing in financial subsidiaries. Okay. The financial subsidiaries, to the extent they invest, the money is going from your end. So ultimately the subsidiaries, they suffer a loss. So ultimately it will impact, it will affect the functioning of the parent office. For example, Canara Bank, State Bank of India, so many banks are having subsidiaries. So the investment in subsidiary also, they don't recognize as a real capital. It has to be the real strength depends on, real capital depends on. Better you don't recognize right now for the purpose of calculating the real tier 1. Okay, madam. So these are the regulatory reductions.
Calculating tier 1 capital, we have to minus all these components.
Yes. Okay. So that your real tier 1, your real strength will come to know. Because this will, ultimately, this is going to affect your capital. Right now, we will recognize as a, yes, it will, let it be shown as a deduction. Okay, let us deduct afterwards. Loss always, you remember, it has to be deducted. Earlier, they have to put accumulated losses. Now there is no question of parking the asset side. If the loss is there immediately as per the new Companies Act 2013. Any loss in the current year, it is accumulated loss. Earlier they have kept it in the asset side. Now you cannot keep the loss in the asset side. Same year you have to financial year, same year you have to minus it from the tier 1 capital. That's a current capital this company law, new law. Agreed, madam? So all these Basel III advocates better don't recognize right now. So this will impact your, okay, why you are artificially showing. So let it be reduced. Okay, right now. Okay. So they will ask us, yes, this question, this I think this is a summary. CET1, what will qualify? I think when madam asked, what are the qualifying, yes, instruments under CET1, AT1, Tier 2, all this list. I think this already you have, yes, understood when the regular sessions are there. I am again giving, and also I am giving at the end. Just to have a look at it. Stock shares, yes, CET1, premium, CET1, capital reserves, there is no discount, CET1, the free reserve, CET1, the balance in the surplus, the P&L account surplus, CET1, the revaluation reserve at 55% discount, CET1, the foreign currency FCTR, 28% discount, CET1. So similarly, 81, these two items only, PNCBS and the PNCBS issued at a premium, that will also become 81, and IPDA, innovative perpetual debt instrument, where the call by the bank can exercise the call option only after 5 years. So these things will qualify as 81. And tier 2, okay, then you may want tier 2, all sorts of provisions, all sorts of debts, subordinated debts, all will subordinated debt means secondary debts, all general provision and standard assets, all 1 to 6, all should not exceed. How much will be recognized at tier 2, not entire thing. So it will be the all provisions, provision. So 1.25 of credit risk weighted assets, the sigma mean cumulative. So all put together, it should not exceed, and the maximum should not exceed 2% of the, this 2% is different. This 2% will be calculated on total risk weighted assets. Okay, so the tier 2 capital overall should not exceed 2% of the total risk weighted assets, and the provisions alone for bad debt, standard assets, NPA, all these provision, they are allowing us tier 2 up to 1.25. The remaining can be used for reducing your yes, NPA and all. Other accounting will be different. So tier 2, for the purpose of tier 2, this is the rule. Okay, friends, this I think you'll have discussed in your.
Hello, sir.
Yes, madam.
To recognize the tied to capital in the evening session, you told two things, sir. Cumulative and one more thing.
Non-cumulative. Cumulative mean, madam,
sir.
cumulative mean always
tier
it become tier 2, madam. Tier 2 it will become tier 2.
That's what, sir. To recognize tier 2, two types of things you told, sir. One is cumulative, and the
Yes,
other
yes,
one
yes. Subordinated debt. Subordinated debt means secondary debt.
Okay,
What is
debt.
subordinated debt? Yes, yes. Okay.
I understand. Thank you, sir.
Yes, yes.
Where is PCPS located?
BCPS, PCPS tier 2 only, madam.
Here it
PCPS,
is not
that
there,
is
sir.
perpetual cumulative. Cumulative always will under tier 2. I think this list they have missed one thing. Yes, you are correct. So tier 2 consists of PCPS also, subordinate debt also, all provisions also. Only provision there is a total provision, there is a restriction. Okay, this will qualify tier 2
Hybrid
and
debt
within the
also.
sublimit. Okay.
Sir, what
I
is
think this will have,
CCB 2.5?
that is to be built out of your profits every year. I think another few minutes you wait.
Capital conservation.
Supposing your CET is very low, mean you cannot declare any dividend. Whatever profit you are earning, okay, if it is up to 5.5 to 6.125, and the slab I will go. So CCB is always created out of profits every year. So the profit you should not declare dividend. So you have to build up capital conservation buffer out of profits every year. How to construct? Just wait. Okay. So this is the summary. Just to keep in mind.
Sir, expansion of CET, sir.
Huh?
CET expansion.
CET means common equity tier. Common equity tier. Tier 1. Tier mean is a layer. Is a layer. Strong capital. The common equity mean that cannot be converted to debt and all. Is a common ordinary shares. Madam, common equity other name is ordinary shares. And the other form of share is preference shares. Normally, common shares are very popular. Common equity, common shares. That is why they are called as. What is the common share? The declaring dividend is at the discretion of the board. But in preference share, whether the company earns profit or not, you have to give them a
Preference is right
prescribed
one.
dividend you have to give. That is why preference share, ordinary share. The ordinary share, they are also called as common shares. Common equity means strong equity, tier T1. CET means common equity tier 1. Okay. AT means additional tier 1. So these are the components of tier 1. Tier 1 consists of two layers. Okay, both are strong. Both are strong only. Earlier this perpetual and all not was there is a recent concept. Recent concept. Now you look at the question. Perpetual bond, what are the characteristics, features? It has got liquidity, yes. It is tradable. It can be traded in the market, listed in stock exchanges, yes. No premature closure by the investor, no. Investor cannot exercise any put option. There will be no put option. Coupon rate generally higher than the Government of India bonds. Government of India bond, the rate will be low because it has got highest liquidity, highest, yes, no risk also, zero risk, highest liquidity. That's a Government of India bonds normally will be at a lower interest rate. But the perpetual bond, because the investor is taking risk and investing in a higher time, normally you have to attract them by offering little more interest than the Government of India bond. Then not issued with put option. All these are the characteristics of perpetual bond. Now the question will be, which is not a characteristic, which will not apply in respect of a perpetual bond. If you keep all this in mind, any question, indirectly they will ask, which are not the characteristics, which is an odd man out. That is the meaning. Which are not the character, which is not the characteristic of perpetual bond mean perpetual bond. These are the characteristics. One sentence or two sentence they will give something ulta just to mislead you. So you have to take that as yes, not the characteristics. Okay, friends. Negative answer they will give. Which are not the characteristics, which is not applicable, which is true, which is not true. This will be the, you have to read the question carefully, which is not true, they will ask, which is true, which is applicable, which is not applicable. Okay, so which are not the characteristics, like that they will. So unless you have a thorough understanding, anyway, if they ask any options, let them give. You quickly focus on your questions. Okay, answer the questions. Now another question. A loan granted. Now we have to come to provisions or classification. IRAC, income recognition. A loan granted on the security of bank deposit. Okay. Interest due. Okay. Interest debited. But the normal rule is if the interest doesn't get paid after with whatever interest debited at the end of 90 days, after expiry of 90 days, the interest doesn't get paid, the account will slip into NPA. This is the standard rule. But in respect of the loan on its own deposit, margin is already 40. 10 lakh deposit, you are given only 2 lakh deposit, 2 lakh loan or 3 lakh loan. So margin is 60%. Now that borrower has not paid the interest, and so the interest, if we strictly speak, it should be a NPA. So what is the stand? How these accounts shall be classified? I think all of you are aware. This will not be treated as a NPA just because they have not paid the interest. Interest is remaining unpaid beyond 90 because so much margin is available. So much margin beyond the stipulated. The record margin is normally 28%. The record margin is available or more. So to that extent, even if it doesn't service the interest, you don't classify as, especially the security of bank deposit, NSC, LIC, bank deposit. Just because the interest is in arrears, it doesn't get classified as NPA. Agreed, understood? This I think all of you are aware. So that is why.
Just one clarification, sir. As
Yes,
per
boss.
latest norms, nowadays from I think June onwards, interest
Hmm.
should be covered on FD/OD, fixed deposit or OD. Interest should be covered. Otherwise, it is treated as NPA, sir.
Even in deposit, all accounts are only. Now the question is, huh?
FD/OD, fixed deposit, OD against fixed deposits.
Fixed deposit.
Sir, OD
No,
account,
on
sir.
the
Fixed OD, sir.
huh?
So that is
Interest
not
should
OD
be
account, sir. Cash
sir.
credited OD account.
No, that is CCOD are different, boss. This is a different. This
No.
is
I am not asking CCOD. This is against fixed OD against our bank own deposits.
But the norm is the margin. If it is more than the stipulated margin, more margin is available. But RBI guideline tell you need not have to classify as NPA. Margin disappear,
No, sir,
okay.
interest should be 90 days. Interest should be covered.
Okay, covered. But it is not because it's covered, but it's a security and margin available is wide margin is available. No, margin available is still there. Then you should not treat this as a NPA. Just to have a look at it, boss. Okay, I absolutely I don't deny, but the RBI wants because on deposit margin is so much available. Just because he has failed to pay the interest, don't classify as yes NPA. Okay, that is the just have a look at it. Don't worry. I will
But
have a
in
look at it.
actually, it is in substandard category. In my personal opinion, in my branch also one case is like that. Customer is not servicing for interest, but margin is there. Sufficient margin is there, but it is in the status. It is showing as substandard only.
Oh, it is substandard. I think then they may have modified
latest
the
guidelines,
guidelines.
sir. Latest guidelines.
Latest guideline. Okay.
Yes.
So it will be classified as NPA. Substandard means NPA.
NPA. Yes, sir.
NPA. Even if the margin available.
Yes, sir. Yes, sir.
Are they specific?
Yes.
Okay, I will check. Okay. Then you have to check up the latest guideline. But earlier, I think they were telling clearly the margin available. Yes, stipulated margin available is the margin, stipulated margin or more margin available because he has not serviced the interest need not be classified as. Okay, I will check up. Okay, friends. Yes, you have to be updated because whatever later changes also, when the changes came, yes, anyhow December, next week you are going to attend the exam. So the later change also they will take into account. But some changes, there's a cut-off date. Okay, when this has come, just recently or
No.
No, sir, you are correct, sir.
Cut-off date given, sir.
Only
Up to
for
June.
CCOD.
June, sir.
June, sir. Cut-off June.
cut-off June,
June.
Okay.
Yes, sir.
Okay, friends. Anyhow, you reference, very good. Because some of you, that is the purpose of a group discussion like this. Very good. Okay. Now, question number 38. I will check up again. Now, question number 38. 3 banks. This is a normal thing. You are well aware. 3 banks give 500 crore in a consortium under a joint lending agreement. And banks A and B, 2 banks classify as NPA. How the bank C will classify? This is the question they will ask. Okay. Now, normally you will sometimes the people will pick up the answer as, sir, consortium leader has classified as NPA. So other bank also will follow the rule. No. Here for the purpose of classifying as NPA, the conduct of the account at the respective bank is the criteria. Whether the interest is serviced, installment is serviced properly, then it will not slip to NPA. But the interest and installment, yes, not serviced within the due date, 90 days from the due, then it will be recognized as in their books. So there is no compulsion for the other members. Okay, each member as per their conduct. Understood the guideline? No, correct. This guideline is same, correct? Yes, bank C classify depending on conduct in their branch. Just because other banks are classified, they need not have to classify. Yes, okay, they need not have to fall in line with the consortium. Okay, friend. So this they will give it in a different way. Now, now you need to create provisions on standard assets also as a very prudential way, or in a, this also called counter cyclical, or your proactive approach. Because now, okay, yes. So the agriculture loan, okay, 0.25, even on standard agree. Okay, next is, I think all of you are aware of this. SME loan, again 0.25. Standard. This is only for standard assets. Okay. And if it is a real estate category, it is 1%. 1% will be the standard loan also will be provided for. You have to create provision at the rate 1%. And if it's a real estate housing, real estate that is within the complex housing loan, that will be 0.75. 0.75. Suppose other than general category, 0.40. General category on other standard assets, 0.40. I think this you are all familiar, but anyhow, keep it in mind. They may give a may give a problem also. How to what are the standard? Yes, on standard assets, what is the provision needed? Okay, now substandard assets always will have a doubt. Sir, substandard assets, how to create a provision? Now the no complication, very simple. Secured substandard, unsecured substandard. There are two categories of substandard. How to treat the security and all, you don't have to worry. Secured means completely covered by collateral or completely covered by prime or collateral security. Then it is said to be secured. Supposing there is a shortfall in the value of securities, value of the exposure, then it is unsecured. So here the rules are very simple. Earlier some confusion was there. So RBI has clarified. Suppose it's a secured substandard, just provided 15%. Just provided at 15%. Suppose it's unsecured substandard, securities are less or securities are missing. Okay, for some reasons it has slipped to yes, substandard assets. For the reason as security available is not covering the liability or any other reason or other reason, then you have to provide additional 10% as additional provision. So the overall provision will be 25% without reference to any securities. That's the word they are using. Don't worry about flat 25 if it is unsecured, flat 15 if it is secured substandard. Okay, friends. So this question normally they will not ask, but doubtful 1 year, doubtful 2 year, doubtful 3 year with the ECGC cover, with the SME cover, definitely they are asking how to go step by step. Up to this understood, yes, this is simple, straight. But sometimes they will give a question like this. Bharat Enterprises classified as doubtful assets year 1, credit limits 40 crore, and the value of security 5 crore. Sometimes they will give ECGC cover also. Now I am not giving any EC cover. Okay, so this I think it is going. What is the provision needed for this exposure? So the ground rule you have to understand. What is the ground rule? Year 1 doubtful, year 1 mean on the value of securities you have to provide 25%. Okay, value of securities only. Securities only 25. Unsecured portion 100% is the rule. First rule you understand. But now how to calculate the unsecured? The provision requirement for doubtful year 1 rule you remember. I think rule is same, 100% unsecured because so many changes are taking place. Sometimes you used to, yes, okay. 25% on unsecured, secured component, 25% provision, unsecured, entire unsecured. Agreed, Okay, now we'll calculate. Okay, now we'll calculate. Why it is jumping? I think this point of time it is jumping because it is taken from, yes, okay. Now, credit limit 40. Securities available only for 5 crore. Year 1 doubtful. So what is the unsecured? 35. Unsecured become 35. NDR 35 you have to provide. Unsecured, no doubt, 35. So 35 NDR provision 100%. Unsecured. Now, secured how much? Security available 5 crore. On that 5 crore also uncertainty realization. So 25% provision you have to make. So 525 or yeah, what is this? I think automatically moving or because of some issues. Okay. 5 into 25, 1.25. So the total provisions will be 35 plus 35 is unsecured 100%. Secured component, yes, 25%. 36.25 is the total provision available. In one example, keep the steps in mind. Don't miss the steps. Don't get a wrong answer. Understood or not? Okay. Here again, they will bring another question. I will bring ECC cover also will come to the picture. ECGC cover, CGT SME cover, in a similar situation cover. Then little different you have to calculate. The uncovered component has to be calculated in a different way. Unsecured component. Unsecured component, you have to calculate in a different way. Otherwise, steps are same. Okay. Now understood the steps. Now question number next. Question number next. The same Bharat Enterprises, just for example. Year 2, credit limit 40 crores. Now securities available 15 crore. Now what is the provision needed? Okay. Now we'll first find out. Rule is year 2 mean 40% on the secured component, 100% on the unsecured component. This you always remember. Okay. Why it is going high? Okay. So this is the rule you have to keep in mind. Guideline. 100% unsecured how much? Okay. 40 is the rule. Okay. Now unsecured how much you will find? 40 crores the exposure. 15 crore is the security available. Okay. The prime security is available. So the 25 crores is unsecured. And 25 crore you provide 100%. So 25%, 100%, 25. Now secured component how much? Security available, not secured component. Security available 15. On that for 40% you have to give provision. So 15% 40 is 6. So 15 plus, okay. What is this? Secured component 15. Okay. Yeah, okay. So the 25 plus 6, 31 crores will be the total provision. Understood or not? Okay,
Yes,
please. Okay. Okay, please mute, madam. Okay. Okay, now question number 47. Gold loan, loan granted to same Bharat, but year 3. Credit limit 40, value of security same 15. Now what is the provision available? You follow the same rule. Unsecured 25, unsecured 25, okay, and secured also to 100%. So totally 40 crores will be the total provision. You calculate either this way, you'll get 40 crores only. Agreed or not? Same rule you follow. 100 crores, 100% on secured and 100% on, yes, unsecured. So that means 100% on, okay. Now I am bringing ECGC cover. ECGC cover, loan granted to Bharat. Now same question, but I am bringing ECGC cover. Now the calculation will undergo a small change. Just to keep you alert. Yes, I have brought this question. Okay, now year 2, one question only, ECGC. Okay, now year 2, credit limits 40, value of the security 15. So the, okay, now first you have to calculate ECG cover. Yeah, there without EC cover, straight away you have gone. Now EC cover first you have to calculate. Then you apply the normal rule. What is the normal rule? Normal rule, you know, yes, unsecured 100%. Secured mean other than ECGC. ECGC again don't put don't put that. Secured 40%. That is security mean other than ECGC. That EC also a security. And now how to calculate step by step. Unsecured exposure. How much? First you have to calculate what? ECGC cover. How to calculate ECGC cover? Why this slides are moving? Okay. Okay. First for EC cover, you have to calculate like this. First, calculate EC cover. How to calculate EC cover? Exposure this. Security this. So 25. The ECG will settle on, they will give, definitely they will give. EC cover 50, they will give, 60, they will give, 75, they will give. Okay. So, sir, how, okay, they will, whatever they give, you take it. So, on 25 crore, because uncovered, the EC will settle after adjusting the security only. They will never give on Yes, entire. Okay, I think some problem. So 25, 25, how you got 40 minus 15, 25. On that EC will give 75%. So 25 minus 75%, 18.75 is the expected settlement from ECGC. Now, unsecured, how to cover, 40 is the exposure, 1875 may come from whom? ECGC. The 15 is the value of the securities. So the 6.25 is the unsecured component. Entire thing you provide, 100% you provide. Then on the 15, not on 18. 18 is a ECGC. There 0. So on the 15, you have to again provide 40% because the second year. So the provisions for the security is because that is a likely loss. The 15 lakhs you may not realize. You may lose 40%. So the loss may be 40% of 15 is 6. So the total provision should be 12.25. Okay. When EC cover is there, you have to calculate in a little different way. Understood or not? This question definitely they will ask. Okay, boss.
From where six you got total provision 6.2 plus 6.
Till 40%, 6.
Yes. You don't miss the steps, boss. Understood the steps. First you find out unsecured exposure. Here ECC cover also you have to minus. If there is no EC cover, straight away minus security. But ECC cover first you have to calculate. EC cover how you have to calculate? For calculate EC cover, first you have to minus the security. On that only you have to apply the percentage. So 18.75 will come from ECGC. 18.75. The 15 is the security. So the total unsecured may be 6.2. Entire thing you provide. Then what is the 6? 40% on the security. 40% on the security, 6. So 12.25 is the total IS provisions to be made.
40% on what, sir?
Huh? Yes, madam. 40% on the value of the security, madam. Value of the security because year 2, na, madam. Year two, that you have to keep in always mind. This you have to work out separately. Then you pick up the correct answer. You need some working. You keep. I think you are permitted to carry a calculator, not scientific, and you are given a rough paper also. Go on calculating. Now you see, I am bringing SME account. A loan granted to SME, 40 lakhs. Doubtful 1 year. CGT SME cover 75. Security available 10. Now when CGT SME cover is available, like ECGC, you have to calculate in a different way. If no ECGC, you will calculate in a earlier. That is why the steps will change. Slight change only. First one, rule is same. What is the rule? Unsecured 100%. Secured first year mean on the security also 25%. This is the rule. Rule you never forget. Okay. Now you have to calculate CGT SME cover. How to calculate CGT SME cover? 40 is the loan and security is 10. This CGT SME will not settle on 40. They will see how much securities are available. Security mean not collateral. Prime securities only you have to charge. So the 40 minus 10, 30. On 30, 75% mean 22.50 will come from. 22.50 will come from, yes, your 22.50 will come from credit guarantee scheme. Then that you recognize as a security, and the 10 lakh already physical securities are there. So the total uncovered mean 22, 32, 7.5. The 7.5, 100% you have to provide. Then the security available 10%, 10 lakh. On that 25% you have to provide. So 25, 7.5 plus 25, 2.5, 10 lakhs is the overall provisions required in this example. Is a definite question. Remember, calculate carefully. Okay, one more question. Only one mark, but you have to follow the steps carefully. Okay.
Please repeat, sir.
I will again upload. Now one more. Okay. Now this is a twisted question. This is a
Sir,
twisted
49,
question.
please repeat, sir.
49. Okay, madam. 49. 49. you have given 40 lakhs. Outstanding exposure is 40 lakh, but it is doubtful year 1. And CGT SME cover available is 75. Security, this is the background information. Doubtful year 1 mean remember the rule. What the remember the rule? Unsecured always will be provided 100%. The secured component, security, also will be provided at the rate 25%. What is the 25%? By selling the security, you may realize only, yes, you may suffer a loss 25. 75% only you may realize the value. That's the meaning. So the 25% likely loss you have to provide. So the rule is first, what is the unsecured component? Earlier, there is no CGT SME, straight away you have minus security. But CGT cover, you have to first minus. Then security also you have to minus. CGT SME, how to calculate? CGT SME will not settle on 40. Always they will recognize, they will ask how much securities are available. Okay, 40 minus 30, 30 lakhs. Yes, security adjusted. On 30 lakhs only, they will settle 75. 30 minus 75, 2250. Okay, so the unsecured becomes what? 40 is the exposure, 10 is you are going to get by sale of securities. The 22.50 you are likely to get from CGT SME. So the uncovered component, unsecured component becomes 7.5. For this, the rule is you have to provide 100. So 7.5 100, and the security available 10 lakh. On that you have to provide 25. So 2.5. So the total provision is 10 lakhs. Understood, madam? Understand the steps? Okay.
Yes, sir.
Don't lose
At
the mark.
75 CGT MSc provision is.
They will give, madam. They will give. They will give cover. They will give, and you have to recognize first for calculating CGT cover. First, you have to adjust the security. You are not going to sell it right now. So you have to notionally, you have to imagine your securities you are selling. So minus that, on that only they will give 70% or 60, whatever percentage settlement will be on, excluding the security. They will never settle on ECGC also, CGTSME also. They will not settle 70% not on the outstanding. They will see whether securities are available. If the securities are available, that they will minus it. Agreed? Understood, madam? These are the important questions. Okay. Now this is another important question.
ECGC cover and the CGMT cover, both calculation method same only, na sir?
Yes, yes, same way you have to calculate. Very good.
Okay,
You have to calculate. The steps are same. CGTSME cover, ECG cover, the rate of cover they will give, you have to calculate accordingly. Okay, step 1, you don't miss the step. Yes, you will get. Okay, very good. I think you are great people. Okay, loan granted.
The amount is 300 lakh. ECGC coverage is 75%.
Yes, 70% up to 200 lakhs only.
That is up to 200 or up to 150, sir?
No, that is 200 of 70% is 150. That is, they are giving 70%, but now their cover is extended up to 200, On 200, they will give 70%. So the maximum cover from, CGT SME will be 150 because now they are extended the cover. Earlier they were restricted to 100, and now they will also, there are two covers, friends. Yes, you are correct. The industrial activity up to 200 lakhs, but service and trading activity only 100 lakhs. That is again, the CGT SME cover is available without collateral. Bank can give a loan without collateral. Their CGT SME's cover is available for manufacturing units up to all funded facility, non-funded facility. For manufacturing unit 200, for service units they are restricted to 100 lakhs only. Agreed? Yes, without collateral. Your bank can give, but collateral will be restricted to this amount. The availability of collateral will be restricted to this amount. Bank can give anything, okay, but they are not supposed to charge collateral because to get the CGT SME cover, they are not supposed to charge any collateral. Bank will, yes, the bank normally will take, if it is no, anyhow, they will not miss the CGT SME. So even if they give beyond that, up to this cover will be available. Cover will be available, provided they don't charge Yes, collaterals. Okay, friends. Okay. Now, yes,
Sir.
bank.
Sir, question number 50 explain, sir. Question number 50 missed.
Sir.
Question number 50. Yes, madam.
Sir,
Okay, okay.
I have a question. I have a question.
Ah.
Is any question can be framed like this if one in SME working capital and a loan is granted and one is substandard and other is standard, one provision on that. Any question can be framed or not?
No. That is not at all a possibility.
Loan
Because
NPA means all loan will become.
all loan. The category of the loan.
That I'm saying na, ki if they say ki
No.
loan is going NPA.
That is conceptually it is incorrect, madam. Conceptually it is incorrect. No question will be framed like that. Okay.
Okay, okay, sir.
Don't worry. Because the concept is incorrect, Okay, now you see one beautiful question. Look at the question. Loan granted to an exporter. 40 crores you have granted. Okay. ECGC settled. ECGC is not going to settle. They have settled. ECGC 30 crores they have settled. After they settle, there is a cash flow. By something they happened, they got a realization. Okay. They will recognize this, but afterwards, some recovery. Maybe they have got some cash recovery. Okay, maybe any other way, they have got cash flows. 10 crore they have got after the settlement. Now the question is, what is the net loss to the bank? But remember the rule. In the rule, you have to remember. Rule will not be given. Yes, no recovery. You note down the rule. This is ECGC rule. What the rule, any recovery, cash recovery, after settle, note down, then only you will remember. Any cash recovery after settlement by ECGC, the recovery bank cannot keep. Bank cannot keep the entire amount recovered. Bank cannot keep it for them for adjusting the loan. They have to share that recovery in the same ratio. ECGC settled. You understood what I am telling? This is the general agreement between whom and whom? Bank and ECGC. How many of you understood the rule?
Pardon, sir.
Yes, boss. Understood.
Sir, recovery.
Sir, please repeat.
Madam, ECGC has settled, madam. After settling, you get some recovery from the customer. ECG has settled in good faith based on the data. They have settled. They will have their own calculation. They have settled. You immediately will not be adjusted to the loan account. It will be kept in SL, that is until liability as a suspense account. Okay, till the final picture emerges, you have received settlement. Okay. Now what happened? You are getting a recovery. Okay. You are making a recovery. Recovery means what? Either by pursuing the borrower or something you had that reconciliation or a compromise. He was paying something, so you are able to make a cash recovery after the ECGC settled. Now the recovery made by the bank, whether bank can retain the entire amount or something they have to pay back to ECGC. That is my question. All of you understood the question or not? Whether the recovery can be kept by the bank.
Cannot be kept, sir.
Cannot be kept. Why cannot be kept?
Some ratio is with
Yes.
ECGC, sir.
The same ratio. Same ratio you have to settle to ECGC. ECGC will settle in the same ratio. You see the question. 40 crore was a liability. Settlement was 30 crore. So 75% they have settled without reference to any security. At that time, they are not recognized. Okay. So 40% liability, 30 crore. So what is the rate of settlement? 75%. Remember. So the EC has settled 75%. Okay. Understood. Now we have got 10 crore as a recovery, post settlement recovery. This is called post settlement. The entire 10 lakh we cannot keep. The entire 10 lakh we cannot adjust because already EC has settled 75%. So the 75% of 10 crore has to be paid back. Okay. So the 10 crore, 75% is 7.5 crore you have to pay back to ECGC refund out of the 10 crore only, not out of this. The 10 crore you have got recovery.
That 75% belongs to bank, no, sir.
No. ECGS are given 75 na boss.
Yes,
ECS
sir.
settled 75.
No. After post settlement also, it goes to for bank only, no, sir. 75%.
No, that is ECS shared your loss. ECS settled how much, boss? 75% of your loan they have settled, you know. So the
Yes, sir.
75% they have participated in our loss. So
Yes, sir.
when the recovery is there, same ratio they should get back. Bank has borne how much? Bank is bearing the loss 25%. EC is bearing the loss 75. That is why they have
Yes, sir.
settled. That's the purpose of ECGC, you know. That's the
Yes,
otherwise
sir.
why you go to ECGC.
No, out of 10 crores
Understood.
also, 75% should be
Yes,
paid
yes.
with.
Yes.
తినింది
That's the rule. That's the rule, boss.
ఒక చపాతి తినింది ఇంత బిర్యానీ అన్నం తినింది
Okay.
Okay, sir.
Understood, friends?
Sir,
So understood?
దాంట్లో అవన్నీ వేసింటారు ఏరేద్దా
Percentage has to
అర్ధం అన్ని ఏరేసి ఇస్తుంది
Oh, madam, yes, is not
Please make
unmute.
mute to all.
Yes, that madam has to be told when she is talking to somewhere off the screen. Yes, he has to mute. Okay, now understood or not, boss? How many of you understood? Any recovery, simple, you have to pay back to ECGC in the same ratio. You cannot
in the
keep
same
the
ratio.
entire amount.
Recovery in the same ratio, profit
Yes,
also in
yes.
the same ratio, no, sir.
Yes. That is you have to pay back. The ECGC recovery, our point is only 3.2. No? 7.5 crore you have to pay, give them back because they have.
No, sir. We have to get. They are settling 75. They are settling 75% to the bank, no, sir.
Yes,
now
yes,
also
yes.
they have to settle. Now also they have to settle 75% to our bank, no, sir.
No.
The recovery is after settlement only, na?
This is after settlement. Boss,
If
this
they recover,
is
if they recover
settlement from-
total 40 crore, then they have to pay back 40 crore to.
This is not the money. The 10 crore is not the money coming from ECGC, boss. It is coming out of our efforts. Out of our
Yes, sir.
efforts, the entire 10 crore does not
30
belong
crore
to us.
coming from ECGC, sir. 30 crore coming from ECGC.
Yes. So the overall loss is already 30 is there. In the recovered component, we have only we can return only 2.5. So totally we have recovered from ECGC. We have recovered 30. Though we have recovered 10 crore afterwards, we are paying back to ECGC 7.5. 70% we are paying back. So the 2.5 only is available. So in overall we are recovered to 32.50. So the net loss to the bank is 7.50. You click it, 1 mark. It's a twisted question. It's not a direct question. Indirectly, you have to apply. Yes, and you have to arrive at the answer.
Sir, how many percentage we have to share with the ECGC, sir?
The same ratio, madam. Same ratio. When they have settled in,
Same
they will
ratio,
give
okay.
indirectly. They have given indirectly.
Okay, sir.
40, 30 means 75, no, madam. Same ratio you have to share with them. Because they have borne our loss of 75%. So they are giving us 75. So like that, yes, we have to. Now I think some of you wanted a where question. The bank invested 1,000 crores in assets which are 2% volatile per day. Per day it is volatile. Oh my God. What's the where? They have invested 1,000 crore. What's the value at risk for holding these assets for 1 full year? Assume 250 days trading. They will assume 250 days trading. So the formula simple. Where is equal to, what is where? Value at risk in quantum or value at risk in percentage. Value at same formula, rate of volatility 2% into square root of per day and year. Normally 365, but they already told assume 250 trading days. The square root of 250. Square root of 250 will become 15.81. So 2 into 15.81, it is the percentage of risk. 31.62 value at risk. Simple formula. Then what will be the likely loss? What is the risk in this portfolio? 1,000 crore, 31.62 may become a loss. So 316.20 is the maybe a loss, potential loss. Where is nothing but value at risk. That means potential loss a bank may suffer by holding some assets over a time horizon. Maximum, yes, it is up to 1 year. Normally, the where will be calculated up to 1 year, and that is a normal question. They will, the big question they will not give you because you have to calculate within 1 minute. Yes, so they will. Yes, so the answer is where is 316. Sometimes they will ask what is the capital needed. Sometimes they will ask what is the capital needed. Capital needed means 9%. Loss, always capital has to be provided for the likely loss. Okay, so this is question number. Don't worry about the number, running number have changed. Now next question is, I think one of you wanted in the morning. If yearly volatility is 17 point, only one line. See, if yearly volatility is 17.32, what is monthly volatility? Alright, great. Yearly volatility this much, only one line you have to calculate. You should know the formula. Otherwise you cannot do. What is the formula? The where value at risk in percentage or value at risk in amount is equal to rate of volatility. What is the rate of volatility? You do not know. Rate of volatility in the time, monthly volatility they are asking. So the rate of monthly volatility, let it be X. Let monthly volatility, let it be X. The question is X, you have to find out X. But now what is the, you apply the formula, apply this parameter, this data in the formula. Where how much they have given? Yearly volatility is 17.32. That is mean the yearly these assets are fluctuating either plus or minus. It may lose the value by 17.32%. That is the meaning. So 17.32 equal to, okay, X, your monthly volatility, let it be X, into square root of 12. Why you are putting 12? Because yearly month means square root of 12. So the square root of 12 will be 3.464 if you get. Now 17.32 divided by 3.464, then you will get X is equal to 5. So the monthly volatility will be 5%. The answer you pick 5%. Only 3 parameter, any 2 parameter they give, the third one you can find out. Simple calculation, but you should know the formula. Without knowing the formula, you cannot do. Where is equal to rate of volatility? Simple. The other statistics models are there. That will not be given. That will be very complicated to calculate. Simple calculation you do. Yes, within 30 seconds you are scoring. Understood? 2 models. Now, next one. A bank normally, these are all intelligent question, theory question. Look at the question carefully. A bank normally redeem perpetual bonds using, okay, answer has been given. Oh, sorry, I should not have given the answer. Okay. Usually redeem the perpetual bond using call option rights when blank. They will give 4 options. When market interest rate going up, when market interest is coming down, the holder has surplus fund, when the bank wants the funds urgently, all these are not allowed. This is the answer. B is the answer. Generally, market rates are coming down. Why to hold high rate perpetual bond? Redeem it. He will use his call option. But that call option can be exercised not immediately, only after 5 years. Agreed? So this is the answer. Theoretical question. Out of the 4 options, you have to pick up the correct option. Okay. One more example I will give you.
Sir, for call option always market interest rate coming down.
Yes. Why? Because, okay, now generally market interest rates are coming down. What does it mean? Now we can get the bond at a lower rate. Yes or no? Now you can get the bond. Market is now dull. Market rates are line, but already perpetual bond, remember, always high cost bonds. Perpetual bonds are always at high cost bonds. So why you carry these high cost bonds? You get rid of those bonds. Now you can get the money from the open market at still a cheaper rate. Correct? So that is why this question they will ask. Okay. So this is just a twister question. Whether are you are
they
able
ask for redeem perpetual bond, na?
Yes, madam. Perpetual bond can be redeemed. Who can redeem? only the issuing bank can redeem. When they can redeem, they can exercise their call option. Yes, all normally call option will be incorporated, embedded in the deal. So they will exercise their option. They will redeem. Okay, because rates are falling down. The rates are going up. They'll retain the perpetual bond. Rates are going up, then they will not redeem the bond. If they redeem the bond, again getting the funds will be difficult. Yes. So they will retain the bond if the interest rates are going up. They will redeem the bond if the interest rates are coming down, going down. Understood or not? This is the question. Twister question is simple, but you have to answer correctly. Okay, friends. Now question number 53. This is a question on, okay. I think this question we have done. I think, okay. A bank has 2000 crore. This is just to know current account SP, how to classify. A bank has got 2000 crore current account, 4000 crore SP account, and time deposit falling due 250 during next 14 days. They have clearly told time deposits are maturing 250. Now expected repayment in loan, they are giving some data. Based on the data, you have to do CAIIB analysis. This is a wonderful question. Okay, they will give a data based on the data. I told sometimes they will give a data, sometimes they will give a tabulated form. Expected repayment of the loan next to 14 days, 500 crore. Find out the gap in 1 to 14 days bucket. Now whether it is within RBI guideline. Now one by one you have to remember. So the bank has got 2000 crores mean. So its outflow in the 1 to 14 days will be yes 10%. 10% mean okay. SP okay. SP how much? SP 10% no. Bank has got 4,000 crore. So 4,000 crore mean 10%, 400 crore. It's an outflow. Okay. Now current account 2,000 crore. Which means 15%. So 15% of 2,000 crore, 300 crore is an expected outflow. Next data is data. 250 crore is likely to mature during this 1 to 14 days, next to 14 days. So it is also an outflow. So 250 crore. Next one, so the total outflows, you total it. 400, 300, 950. Inflows are only one or two. Expected repayment loan next to 14 days, only 500. The inflows are only 500. Outflows are like buckets. You have to calculate. So the negative gap is 450 crore. The negative gap in percentage is 450 versus 950. Outflow versus gap. So that becomes 47-37. It's a huge gap. But RBI fixed is only 15. So they are in excess of the RBI limit by 30 to 37. They may give in a tabulated form or they may give a data like this just to be aware of the, yes, I have given this question. Understood or not? Easy to understand.
10% and 15%
RBI fixed 15% to
10 and 15.
Yes. That is by default. You have to remember. They will not give in the examples. You have to remember. I told overnight 5%. Next is 10%. Next is 15%.
20%, no?
Yes.
And why 15%?
No.
15% for what, sir?
No, overnight 5%, 2 to 7
overnight
days
5.
5%,
Next is
8 to 12
15%.
5%.
Okay.
This is 15, madam. 15, madam.
only.
20 is up to 28 days.
28 days.
Yes.
14 to
Correct.
28.
Very good. Okay. That is why you are a fresher. That's all. You know this, but any are a fresher. Now another simple question. PCR they want you to cover. Total advances 15,000 crore. Gross NPA 8%. Net NPA 2%. What is the provision? Indirectly they are asking. You see, simple question, but sometimes they miss it. So the provisions are 8%. Sorry, 6%. What is provision 6% have I got? 8 is gross, net is 2 mean 6% is the provision. 6% of 15,000 is 900. 15,000, yes, 6% is 900. And what is the NP available? 8% of 15,000. So that is 1,200. So 900 divided by 1,200, 75% is the PCR. provision coverage ratio right now. Simple question, immediately within 10 seconds you can calculate. Understood or not? This question they are asking. Okay, friends, any question you can expect. Understood or not? This we have done. Similar question.
Understood, sir.
Provision.
Yes, sir.
Yes. Now, interest rate risk in management. So, is again one more question, intelligent question they will set. Now, you imagine interest rates are going up, boss, for a grade. Now, which of the following situation shall give profits to the bank? Fixed rate liability and floating rate assets. Okay. Fixed rate liability and fixed rate assets. Okay. Floating rate liabilities and fixed rate assets. Okay. Floating rate liabilities and floating rate assets. There are 4 combinations. Which will give profit to the bank?
D, sir.
Yes,
Asset
boss.
should be floating.
Floating rate liabilities.
Very good.
Yeah.
When the rates are going up, you will get more income when the loans are at floating. So assets should be at floating, where it is fixed rate liability, floating rate assets. Okay. And interest rates are going up. You should not pay more towards A is the correct answer. Very good. Great. You are all cracking, boss. Don't worry. All of you are now very sensitive. Yes, I feel all of you who are logged in should crack. That is my wish. That is our wish. Okay. Now
Hopefully,
come
sir.
to next. Yes, definitely. Now when the interest rate going down, they will twist you. Don't worry. When the interest rates are going down, which of the following shall give profits to the bank? You look at the question. Interest rate
Floating
going down.
liabilities. Fixed.
Interest rate going down. Correct. Fixed rate liabilities, floating rate assets are. Fixed rate liabilities, fixed rate assets are. Floating rate liabilities,
Floating
floating
rate
rate
liabilities, fixed rate
C for
assets.
Chennai.
liabilities, and fixed rate assets.
Answer
Floating rate
But now
liabilities,
it is C.
floating rate
Floating rate
assets.
liabilities and
Yes.
Liabilities.
It's an intelligent question. Both should not be floating because interest rates are going down. Then what is the correct pickup? Will you pick up the correct answer? A, B, C, or D?
C,
C.
sir.
C
C.
is the correct answer. Very good, very good. You are all cracking. Okay, because interest rates are going down, So what is the thing? The yes. Because interest rates are going down, you should not lose anything in the loans. The loan should be fixed rate assets. So you are assured of income. But liabilities should be floating, mean you will be able to get deposit at a lower rate. So that is the C. C is the correct answer. This you have to, yes, run a video in your mind. Okay. Now the next question is, which will improve liquidity position of a bank? Okay. They will give some options. Out of the option, you have to pick up. Which of the following combinations will give improve the liquidity position? Now, high ratio of ST assets, okay, because it can be converted to cash immediately, but low ratio of ST liability. Agreed or not? How many of you agree? How many of you agree? How many of you disagree? Yes, tell me.
Agree, sir. Agree.
Agree.
High ratio of ST assets, low ratio of ST liability. That's the answer. They may give so many options, but pick up this option. Okay, 57. Now, agreed, boss? Agreed. Okay. Somebody has to mute one of you,
Can you show the
please.
previous slide?
Yes, madam. Yes, madam.
Only liquidity is more, no, sir.
Yes, madam.
Liability side only liquidity is more. No?
No. You look at the question. Now, generally, interest rates are coming down. Okay. Now, when the general
Not
market
this,
interest
sir.
rates are
Another
coming
question.
down.
57. I think.
57, okay. 57 is a liquidity, which will improve liquidity position of the bank. Similar way, they will give 4 options. But I am giving not option, answer. What is the answer? Which will improve the liquidity position? Our liquidity position means what? Ability to pay to withdrawals. Okay, ability to pay to withdrawals. When you will be able to pay to withdrawals? If you have got a high level of short-term assets mean what? Bill purchased, short-term assets. It will realize fast. CCOD. CCOD is also, CCOD for classification purpose is a short-term advance, working capital advance, short time. Other short-term advances are called as what? ST assets. Okay, cash is also in ST assets. Or some investment, commercial paper, treasury bills. Okay, treasury bill and all that is SLR security, that you will not sell it. Okay, that will not use it for liquidity. But suppose you have invested in commercial paper, it is a short-term investment. So the short-term assets more low, and short-term liability also should be low. Then only bank will be very comfortable in meeting the liquidity. Agreed, boss? So these are the things they will give options, but you pick up this option. They will give 4 options, but this is the correct one you have to pick up. Okay. Yes. Now risk in FCNR portfolio we already discussed. Yes, earlier, I think yesterday. FCNR portfolio, our FCNR deposits are locked at fixed rate, but FCNR advances, that is PCFC, EBR, at floating rate. So whenever the floating rate comes down, bank will suffer a loss. So to avoid the loss, the bank will, this loss is on account of interest rate mismatch. Interest rate mismatch. What is interest rate mismatch? Yes, it is one segment is in fixed rate, another segment is in, that is assets are at floating, deposits are fixed, FCNR are fixed. Yes, so to manage this, I think we already discussed IRS, interest rate swap. Okay, that question. AFS mean available for, I think this we have discussed. The question is, which of these have the highest liquidity? Which of these have the highest liquidity, boss? Answer is HTM. Yeah, all government securities. But these are not having liquidity. AFS. Sometimes nobody will buy. You will not get the cash. Held for trading. Sometimes you will not be able to sell it. Okay, that also. So the highest liquidity in HTM securities. Okay. Now LCR how calculated? Yeah, now we are coming to the very climax of our balance sheet management. Now LCR. What is LCR? How calculated? The liquidity coverage ratio. Total HQLA. What is HQLA? High quality liquid asset. Divided by net outflows. Net outflows. Net outflows mean negative. Net outflows during, instead of negative gap, they are using the word net outflows. During 30 days of crisis, this would be equal to or more than 1. So your high quality liquid assets are more, mean you are having LCR, but it should not fall below 1. Okay, that is the mandatory
Sir,
requirement.
problem comes under this category, sir.
Yes. Next, wait, madam. What's the problem? There are 3 levels of HQLA. Level 1 mean all SLR securities and cash and excess of CRR. These are the things. Now, entire SLR you can recognize. They will give some data, and from the given data, you have to calculate high quality liquid assets level 1. What is level 1? Level 1, remember, haircut is 0. One madam was asking, sir, where you have to apply the haircut? Now here, the assets are there, but always the value you have to convert to cash, In the process of converting to cash, you may not realize the entire value. That is why haircut. Likely loss while selling an asset. Okay. So what is high quality liquid asset? First we will see level 1. Okay. Total HQLA. Total HQLA mean excess of excess here. HQLA level 1. That is actually level 1, level 2, 2A, 2B. There are 3 categories. First category is first loss. that is excess CRR. But excess CRR, CRR is 4.5, but our balance with RBI is more than 4.5. So that can be recognized for meeting our emergent cash requirement. Excess CRR you cannot use. CRR is mandatory, that is locked. And cash at all the bank branches. Entire bank, okay. The CRR will for the chest and all will help CRR, excess CRR only. Cash at the bank, that will also high quality is cash, yes. And all SLR security now they are allowing for the purpose of this is called as level 1 securities. This is called as what? Level 1 security, haircut is 0. Agreed? They will give data. Their what is their NDTL and their balance with RBI. So the excess CRR you can find from the data. They will give indirect data. And the cash at the bank they will give. And all NDTL they will give. And they have made investment this much. Okay. Then entire SLR securities can be taken for HQLA. So the total HQLA, how much? Level 1, how much? They will give data. I will give you one formula also. So level 1, normally, yes, this is how you have to calculate. Okay, now level 2.
This is level 1, sir.
Level 1.
Total
Level 1 means
HQLA minus level 1.
yes. Okay, level 1
is
means
level 1, sir, in this.
Yes. Level 1 means HQLA level 1. Okay, here one word is missing.
For HQLA,
Total HQLA
level 1, this formula. Okay.
Yes. Now for this is the first class liquidity because government, our own cash, it is ready to face the challenge. Okay, so immediately or you can use it. Okay, next one, level 2. Level 2, how calculated? What's the haircut they will ask? Level 2A, level 2B, only 3 categories. Level 2A, remember, all debt securities. Okay, debt securities, normally equity securities will not come here. Only debt securities in AAA. AAA mean 20% risk and plus rated category plus all other investment, maybe commercial paper and any other investments in risk weight not exceeding 20. Any commercial paper or other thing other than banks, you have certificate deposit in banks. Other than banks, certificate deposit will not qualify. Other than banks, if you are invested in a big corporate, is a AAA rated corporate, commercial paper you have invested, bank has invested in the commercial paper, bank has invested in a bond. Okay, these will qualify us, but the risk weighted assets for that category should not go beyond 20. These are classified as level 2A. Haircut will be 1.5. You understood? They will give example.
Any risk weight for commercial paper?
Yes, they will give, madam. In a commercial paper, rated, the AA mean it will go to the next level. AAA mean it will go to this level. AAA mean this will go to 2A. You can recognize them.
That line is there now. All other investments not exceeding 20%. So
Yes. That they will give specifically, madam. Supposing commercial paper mean commercial paper in a AA rated company mean that is beyond 2030. So you cannot recognize under level 2A. You have to recognize under next level 2B. That 2B you can recognize, but haircut will be little more. Agreed. So up to 20.
Sir, 20% of the risk weight assets we are taking like that, na?
Yes. And that is the instrument, debt instrument where the corporate rating, the rating of the instrument, every debt issue has to be rated. Please remember, when they are mobilizing the debt, all company cannot go to the debt market. All companies cannot issue commercial paper. Only rated corporates can issue commercial paper. They can issue debentures. They can issue bonds. Okay, all are equally. You can convert to cash because they are readily saleable. So that will qualify up to debt instrument, whether it is a short term or long term. But risk weight should not exceed 20%. This will qualify as high quality liquid asset level 2A. Agreed or
Sir,
not?
can you
Okay.
explain to the numerically, so it will be more easy to
Okay.
understand.
Yes. Numerical. They will give the data, madam. They will give data, AAA, here. They will, I will give you 1 second. I am having a model. Okay. Now you understood haircut 15. Now the third cut is first definition you will understand. Definition 2B mean haircut is, what is the haircut? Question is total HQLA. What is the level 2B HQLA assets? And what is the haircut applicable for such asset? Now the answer is this. All debt securities, including commercial paper. Okay, so debt security mean need not be long term, short term also. But in companies with risk weighting above 20, 20 and less mean less than 20, only 20 or 0, no company will come. Either it should be AAA rated mean 20, 10% risk, there is no 10% risk. So 20 up to 20 or 20, not exceeding 20, qualify as 2A. But more than 20, at up to 50 also, again, please remember, over 50, if you invest, supposing you are invested in BBB instrument, BBB mean 100% risk, then that will not qualify as a HQLA. Gone. HQLA, necessarily the risk weight should not exceed 50%. That instrument, that company should be rated not less than 50. In that company you have invested, then only it will qualify as HQLA other than banking companies. So then it will be, yes, the haircut will be exceeding 20. Remember, easy to remember, the risk weight exceeding 20, but not exceeding 50. Those debt instrument, long term, short term, all will qualify, including equity instrument. Okay, including equity instrument. Okay, including equity instrument also will qualify as HQLA, but haircut will be 50%. I think I have given one numerical also.
Sir, 64 something left, I think, sir.
Which one left, madam?
Debt securities in above 20%.
About 20% risk weight. The risk weight about 20% risk weight. But
rating, sir. Rating not mentioned.
Yes. The risk weight mean rating only, madam. Is a 20 AAA mean 20% risk category. That is based on rating. The 20% is based on rating, madam. Rating by approved rating agency. Yesterday we discussed. So the more than 20, more than 20 mean 30%. Next is 50% only. Only two instruments. Either AA or A. Okay, and plus shares also. Shares also qualify under tier 2. I think next question. So this will qualify as, okay, this will qualify as HQLA, but level 2B. This question definitely, because is the latest one, they will ask. Identify HQLA and identify what is the haircut. After adjusting the haircut, this would be sufficient to meet the 30 days gap net outflows. That is the final. Yes. Okay. Now we are coming to the climax. Now one small example. A bank has invested 600 crore in Nifty shares. Nifty means first class. Okay. First time we are coming across a equity instrument. Otherwise, debt instrument will only qualify as HQLA. But they are only exemption is Nifty basket shares. Nifty means the big companies only will appear, will find a place in Nifty. Tata, TCS, Infosys, State Bank of India, such shares, if you have invested, and how much will qualify for what level and how category, how much under, oh, sorry, madam, please mute. After some dash person haircut. So the answer is, okay, Nifty shares will qualify as not 2A, it will be 2B and subject to 50% haircut. So out of 600, only 300 will qualify because 50% haircut. Okay. So the first is level 2B, second is rupee 300, and after 50% haircut. So all the blanks you fill up correctly, 1 mark. Okay. So this is how you have to understand. Now, yes,
Sir,
one more small.
excuse me, sir.
Once,
Yes, boss.
once more,
Sir,
please show
previous
that.
we couldn't cap.
Yes, boss.
Again,
This
64
is
also,
shares.
just to show and come back, sir.
Yes. Agreed.
We
Earlier one.
label
No,
to
no,
be.
just explain, sir. Please explain, sir.
Sorry,
This
how it
65,
come in label 2.
Level 2, the level 2 Nifty shares also included, boss. Nifty share, there is no rating, but it has to be included in the Nifty basket, boss. Here no rating. That instrument only rating based. But shares are not rating based. It has to be within the basket of shares which qualify for Nifty index. Again, Nifty index is based on, I think, 50 top performing companies are in Nifty basket. So if that particular company comes under Nifty basket, then the irrespective of the rating, here don't have to worry about the rating of that particular company. The equity instrument also qualify as HQLA, but under what category? Level 2B. And then what will happen? The haircut will be 50%. The market value is 800. You can recognize only 400 as the liquid assets. Okay,
Sir, but
liquidity.
if this is a high
Oh, sir,
rated
when Nifty is given, then
category,
it
it
is
will
level
comes under
2B.
AAA, na? Haircut will be 50.
No, only Nifty
Shares,
2B given.
yes. Nifty 2B. Madam, Nifty shares and all, don't worry about the rating, madam. Shares are based on share equity, no? That is based on, they are coming under the Nifty basket. When they are specifically mentioning, is a Nifty listed share, is a Nifty basket, okay, National Stock Exchange. The basket, it is one of the top shares. Then it will qualify irrespective of the rating. Now, rating, you don't worry, will qualify as what? Level 2B only, not level 2A. And the haircut will be 50%. What is the market value? Market value is 600 crore, mean 300 only will qualify as liquid assets. Liquid assets, because you have to provide for, you have to provide for what? The haircut also. Haircut means possible loss. Okay. Now, one more question. Whether are you remembering or not? Bank has got 460 crore, 640 crore in assets and liability respectively in 1 year bucket. Okay. So 460 is assets, 640 is liability in 1 year bucket, and the interest rate fall by 100 point. What will be the profit or loss by the bank? Now, can anyone attempt this question? Well, yes, logically you can attempt. Now, see, 460 crore is assets, 640 crores is liabilities. So outflows are 640, inflows are 460. Now it's a negative gap. Negative gap. Negative gap, how much? 180 crores.
180.
Negative gap.
Profit share.
Negative gap. Now we have to arrange the funds. Now the interest rates are falling by 100 points. Now tell me profit or loss. Now tell me profit or loss. Tell me, boss.
Profit.
Profit. Don't worry, profit. Because negative gap, you have to arrange the fund. But for arranging the funds, interest rates have fallen down. So you can get the deposit at a cheaper rate. Then profit. How much profit? 180 into 1%, 1.8 crores. Tuck answer. 1 mark, boss. Believe it or not, 1 mark. Okay. But to know that, you should know the concept. Otherwise, you cannot do. What's the gap you have to find out? Then you have to understand interest rate fall mean whether it will be a profit or loss. Yes, profit 1.8 crore. So if you know all this, you can do this question easily. This question definitely, this type of question will be there. You tell me, definitely it will be there. Okay.
This 100 points means, yeah.
100 points mean 1%, madam.
Okay.
1%. So 180 into 1%, 1.8.
Sir,
Okay,
why
1%.
there will be profit if the 1% is falling? It is not written ki where it is
Madam,
falling.
now you have to logically, it's a negative gap, madam. Negative gap means what? 180 crore negative gap. What does it mean? You have to arrange the funds. Now you have to procure these funds, procure the funds from the market. You have to procure the funds from the market by mobilizing fresh deposit. But to saturate the gap, you are going to the market. But market rates are down, That is why you can get that. That is why, oh, sir, interest rate falling, sir, then how you call profit? You have to notionally approach. You have to think and you have to run a video in your mind. Negative gap, you have to mobilize the fund. When you go to the market rates are coming down. So you'll be able to get the required shortfall in funds, deficit, the negative gap. You can mobilize the fund at a cheaper rate, then indirectly it becomes a profit. Okay, so 1.8 crore profit. Agreed. So these are the question. Definitely they are
But
asking.
profit is coming in there.
Yes, boss.
How the profit is coming?
Because the profit, boss, interest rate falling, boss. Negative gap, I 4 situation I remember. Shall I repeat the situation? Positive gap. Now remember. Positive gap, interest rate going up. Tell me, all of you tell me. All of you can now join. Now we are coming to the climax. Positive gap, interest rate going up. Profit or loss? Tell me.
Profit.
Profit. Why profit? Because positive gap means you have got funds, you are investing. Okay. Positive gap, positive gap. Interest rates are coming down. Tell me profit or loss?
Loss.
It's a loss. Okay. 2 situation over. Third situation. Easy to remember, boss. Third situation. Negative gap. Negative gap means you are short of money. Bank is short of money to meet a crisis. Okay. So negative gap. Now interest rates are going up. Interest rates are going up.
Loss.
Very good. Negative gap. Interest rates are coming down. Now tell me.
Profit, sir.
That is why this question. Okay. So 4 situation, don't buy hard. You remember logically, you put a question to you, then answers are already available.
Negative
Okay,
and
friends?
negative.
Yes. Okay. Yes. Logically, you have to apply. Okay. Now, a bank has got 440 crores in a financial year. The current CET is 5.75. How much can be declared as dividend? Oh, this is based on the rule. Oh, it's a good question. A bank has this question, they will call you. The bank has mobilized the got profit 440. Okay. But their current CET is 5.7. Oh. The slab you have to remember. But the slab, is the slab. This thing you have to buy hard bus, no other choice. If the current CET is between 5.5 plus 0.625, that is 612.5, no dividend can be declared. No dividend can be declared. Entire profit to be retained as capital, additional tier 1 capital. This is one. Second one, these things you have to remember. By heart you have to do. Okay, they will give a live example. I think in a regular course you will have studied. Now, next stage. The current CET is.
Sir, this is for capital conservation buffer they are doing so?
Yes. Capital conservation buffer. Okay. So this is as per RBI guideline, boss. We cannot do anything. Okay. Suppose in the current CET is over 6.25, but less than 6.75. These things you have to remember. 0.65, you go on adding. You start with 5.5, 0.65, add 6.125, 6.125, 0.65, you add 6.75, 6.75, 0.65, add 7.375, and 7.375, 0.65, add, you will get 8%. Only 4 slab. If you achieved 4 slab, 8%, then the entire profit can be no compulsion. Entire profit can be declared as dividend at the discretion of the board. RBI will not interfere. But before giving entire thing as dividend, you have to take a permission from RBI. So here, why? Because they are creating a compulsion. If your current this one CET is too low, don't give any dividend. Entire profit you convert to capital. You retain as capital. Next stage, okay, slightly it has improved. Now 80% you retain as capital, 20% you give a dividend. Okay, next level, 60% you achieved. 6.75, it is in between 6.75 and 7.35. So you achieved 100 rupees profit, 100 crore profit. 60 crore only you retain. The remaining 40 crore give us dividend. That's a liberty. It's not a must. Yes, they can decide, but this is a must. 180 is a mandatory. Okay. 60 and above, when 40 can be distributed, doesn't mean 40 only. They can declare only 30, this they can, so minimum 60 they have to retain. So next level, if it is between this one, 40% necessarily they have to retain as capital. The remaining 60 only, because slightly improved, remaining 60% of the profit can, however, be declared as dividend. Okay, yes, and 40% to be retained. Now, if they achieved 80, now afterward, no 20, they already achieved 80%, then there is no restriction. Entire dividend will be their decision. They can decide in any way. They can give dividend or they can retain as capital. That is their board will dissolve. Okay, they are not under compulsion to retain 100%. They can even declare the entire as a dividend also, because they achieved the capital. But before declaring 100% dividend, they should take the RBI permission.